Hi, this is David Duty, and last night, Lan Turner, in his crash course, asked me to do a presentation on how I use TradeMiner and the seasonals. Unfortunately, we had kind of a glitch in transferring over from one webinar to another, and so I thought I would just redo it and show you a little bit more than I did last night. Anyway, I've got TradeMiner Pro Futures Edition open, and I've got step one, which is search. You can see the month of May. 80% of the time, both directions, buy and sell. I've got trends lasting 15 days, no more than 30, with at least 5 years of history. Then I do a search now, and I've got the two check boxes down here selected out, so I won't get into the reasons for that right now. Search now, and you can see that I then go over here to score, and I make my selections on which ones that I want to use, and then I transfer anything that has a 3 or above, sometimes even down to a 2, depending on the market and if it had a huge drawdown one year or anything else, I'll keep it. Then I switch over, transfer all of those. I select those. Let's say from here to here. And then I will click on add to step 2, which I've already done, so I won't do that. And so here are all the trades that I've selected, and I kind of weed them out on which ones I like and which ones I don't like. So as you can see, we've got 14 results here. And let me do a calculate now. As you can see, these have not been calculated, 3 days till calculation. These have been calculated for probabilities, high, medium, low, etc. So I'll calculate again just to show you how to do that. There we go. All right, and then I go by date, start date here, and you can see that on May 1st, 2nd, 3rd, 7th, 11th, etc. are when these are actually going to take place. If you took this one as an example, the Japanese yen, starting on May the 1st, all right, medium probability of that happening, and it's rated at 4.35, or 4.53, I'm sorry, out of a possible 5 score. Medium probability is supposed to be bearish, 5 years of history, from May the 1st through May the 29th. And down here in the bottom, you can see the trades that have taken place during that period of time. All right, and it's already into 2018 since it's past May the 1st and showing you the results. It's got a little bit of a drawdown, $900, but that's okay, and I'm going to show you why here in a minute. All right, so let's get out of this. But you can go, and by the way, you can click on like the Japanese yen here, and it'll show you when it got in short here, and it's got a little bit of a drawdown since the close of yesterday. And you can click on any of those that you want to see. Like here's one that's up 2,000 short the Australian dollar, and as of yesterday, that is up $2,660. So let's close this out, and I want to show you how I transfer this data over to my chart books. All right, here's my chart book for seasonals. And as you can see over here under File, Open, I keep all of my chart booked. I keep the currencies in one chart book, the energies in another one, financials, grains, meats, metals, etc. And then I keep a chart book for my open position. So any trades that I have open go in a separate chart book, and then you'll see seasonals here, right? And so you open up seasonals, which I've already done here. All right, and so these are the seasonals for the month of May. So let's go back through, and I've just transposed all the information, as you can see here, from May the 2nd through May the 31st. That market is supposed to be bearish, rated 5.0. Probabilities are high. It's got 8 years of history and 7 wins. So if you had entered that market on May the 2nd and exited on May the 31st, you would have won 7 years out of the past 8 years. Now, this does not include any commissions and fees or anything else that are involved. I'm just showing you a straight dollar amount. You'd have to take into account commissions and fees, etc. Right? Now, in my webinar this morning, we were looking at the seasonals, and I decided to take a seasonal position on this. So what I've done here, I went in and I looked at a 60-minute chart as my entry position. All right, and I'm doing an intercept order. All right, I'm selling one here. I got to make a change here because I just switched computers, and I'm trailing blue light. All right. So this order will be filled once price comes down past blue light. Blue light will continue back up, and I should get filled here, hopefully today. And so I'll be short that market. Now then, I've got stops on that, and I'll have to go back in because they're in my open orders. But anyway, I can just show you open orders here real quick too. I think I've got those in here. They're on the other screen, so hold on. But you'll see here on the Aussie dollar, I've got this position here trailing blue lights, okay? Let me close this. All right, now I'll probably end up going through and doing a jump stop. And so let's put a jump stop in here and edit this order, and I'm going to put a jump in here. So if the market moves, I think it was 25 ticks. Let me check my opens here real quick. I don't think I had them on my opens. So if the market jumps 25 ticks, I just switched from one computer to the other one to do this. So anyway, if the market moves 25 ticks in my favor, it'll drop my stop down to break even +2. Then I'm going to trail that dollars behind, and I'm going to trail 500 behind. Right, so that's my order. And I'm not going to spend a whole lot of time on, my orders that I placed this morning, but I am, of course, using the seasonal strategies based on that market, supposing to be bearish coming down here. And see these two red lines down in here? Right, it'll actually show you the dates in between here. 23 actual bars, 30 actual days. All right, that this market is supposed to be bullish or bearish, I'm sorry, during that period of time. And if the market is supposed to be bearish, I use red lines here. And if it's supposed to be bullish, which I'll show you one in a minute, I use green lines. So it's just easy for me to look real quick and say red lines is supposed to be bearish. All right. Yeah, so that position looks like it may fill here soon. Let's go to the Canadian dollar and look at the Canadian dollar. All right. Now here, let me move this window over a little bit so we can see better. All right. Now, this market from May the 9th through the 31st is supposed to be bearish, and it's only a rated of 1.9, which I think is very weak, but it's almost a 2. And I keep 2 to 3, 2, 3, 4, and 5 usually, and then kind of weed out from there. No probabilities yet have been done on that one. It actually should have been done. Let me look in here. Probabilities on the Canadian dollar are high. They just calculated, so let me change that. And I'll put that in here. Probability high. Probability is high. All right. Probability is high, meaning that due to current price action, that this is probably going to be a bearish trade here. All right. So let's go back over here into charts. All right. Let's look at the euro. Euro is a seasonal. Let's pull this down so we can see a little bit. And I almost got into the euro this morning. It's been going straight down, but I was kind of concerned because of the Iran pullout of the Iran deal yesterday. It may have affected some of the markets. It did crude, which I'll show you here in a minute. All right, so let me just delete that. Now, if I were to get into that trade, here's where it's supposed to turn bullish, and it's gone straight, or bearish, and it's gone straight down since then. If I'd have entered on that date, and I didn't, unfortunately, that trade would have been up $1,500 in 1, 2, 3, like 5 days. All right, today's the 9th in a week, and $1,500 on that. Don't ask me why I didn't get in it. I missed it. All right. Now, if I wanted to get in that market, I'd probably go to a 60-minute, or you could go to a range chart and look. And you might want to enter short down here somewhere. You might do an intercept order on blue light if you wanted to get short, or wait until it broke support down in here. And then where you place your stop is kind of It'll be left up to your own discretion where you want to put your stops. I'd probably put it up here above this high. And if I got short on blue light, I'd be risking about 750. If I waited for it to break support, I'd be risking about $1,000. Right? Then I could always flip up and start trailing blue light because blue light will flip here. Let's do that just to show you how I would do an order. And remember now, this is based on the seasonal strategies. All right, so let's go in here and trade, and let's do a stop here. And I'm going to pull that up here. We're going to do a stop, and let's say sell the market, and then I'm going to edit the order, and I'm going to say enter that trailing blue light. Then I'd put a jump stop in, a few different things after I'm filled on that. Right? So that's how I would enter a seasonal trade on the euro, right? With a intercept order, right? So I put a stop up here. We're risking 937. I'd have to go into the weeklies to find out where my targets might be. Let's just do that. Let's look real quick on a weekly here. See how much room we've got to go. A long, long way. Before the next support area, we've got all the way down to here. Right? That's $5,000. I like that. $5,000, 4,000. So you could go back in here on your daily, and you could move this all the way down to like $5,000, and we'd be trailing a stop. So probably we're not going to get full $5,000, but who knows? Might get lucky. All right, but I would be trailing a stop on that. Here's the Japanese yen. All right, now the Japanese yen is supposed to be bearish starting the first of the month, right down in here. So we'd had a little bit of a drawdown on that, because if we'd entered here and got short on this day here, well, we'd be at about a break even, but we would have had a drawdown. I'm going to show you how to work drawdowns here too. We'd have had $1,000 drawdown or something around there on that trade before it turned around and went in our favor. So what I suggest that you do, if you see a market that is supposed to be turning bearish, make sure that you would put a bearish trade on regardless of what the seasonals are telling you. Here, that market, if I'd have gotten into that market, I'd have had a stop down below this support area down in here, and might have gotten filled on that one. Yeah, probably would have gotten filled on that one. Had a little bit of a drawdown. So I'd be at about a break-even scenario, a little bit less here. I put a trade on this morning on the Japanese yen. When the market dropped down in here, I've got a sell stop down here, as you can see. All right. And I've got a buy stop down here to take profits on the limit. Now I am trailing that. It just hasn't transferred over, but I've got a jump stop on that one. If we went into my open orders, it would show you here that in my open orders on the Japanese yen, I've got a jump stop of 102 and trailing $500. So let's just change that over here. And so they all match up. 102 for a jump stop. So if that market moves in my favor 100 ticks, it drops my stop down to break even plus 2 ticks. And then after that, I'm going to trail $500 behind, just like I did on the other order. So there's my order. Okay. So I'll be trailing $500 behind. So that market has to drop. And then my jump stop will take into effect, and it'll bring my stop down to break even plus 2. All right. Here, let's go and look at the New Zealand. Now the New Zealand, all right, the New Zealand, that's supposed to be bearish, rated 5.0, and that just came into a bearish position here. All right, it's up a little bit this morning. but it's rated 5.0, high probabilities, 6 years of history with 5 wins. Let's look at a 60-minute chart. All right, we might have another intercept order here. Fibonacci, my favorite, right? From this move here to this move here, the market has retraced 62%. When markets retrace, they have a tendency to go back to this little magic box here, 50, 62%. 62% is the most common. So that's come down. So let's just do this. Let's place an order. Just show you how I can do that. Now, remember, I'm basing this on a seasonal pattern, right? Now, even though I've got a bulls and bears buy signal here, I want to do an intercept order on this. Got slow stochastics coming down, and the seasonals are working in our favor. Remember that. All right, so let's trade this. Let's go in here and say we're going to put a stop order in here. And I'm going to intercept blue light. I'm going to sell one with an intercept of blue light. So change this over here to edit order. Go in here and trail blue light. Okay. So now my order is trailing blue light. So blue light will continue to go back up and up and up until price intercepts it. Now my stop, I had a stop way up here, $1,500. For me, that's a little bit too much. I'm going to bring it up to these highs here. Take an initial now, $800 risk on that. Now then my limit order is way down there at 3,000. That's fine for right now. And we could put a jump stop on this if we wanted to also. Now, how could we figure out a jump stop? Let's say that if this market, and this is something that's kind of interesting. If the market came down here and it hit this low and bounced back up, I'd want my stop to go to break even. So if we want to hear preferences and said ticks, that's 20 ticks, all right? So let's go in and change this order that if we get filled, I'm going to edit this, we're going to put a jump stop in. So my jump stop is going to be 20 because if the market went down and hit support and then that's 20 ticks away, I want my stop to go to break even +2, right? And then we could trail, at that point, we could trail dollars behind, and you can trail any dollar amount that you want. We'll just put in here at 500, right? There's my order. Now we can kind of check our limit by going over and looking at a longer term chart. Look at a weekly, and we've got a lot of room left to come down on a weekly. We could go down $1,800 on that, and there's a lot of support in here at that area. So 67.88. Let's put our stop down just above that. 67.88. So we got a lot of room to go. So let's just move that. 67.88. 67.88. Let's put it at 67.95. Or 88. Here's 67.88, 89. I'll put it at, all right, I'm going to put it at 93. Price has a tendency to go to an even number, which would be, 67.90. I could even shave a little bit off that if I wanted to and go back up here to 68.02. So if the market came down to 6,800, which it will often do, hit an even number, I would take profits just before that. So I've got a $1,600 profit target, and I've got an initial risk of 800. Now remember, if that market goes in my favor, 20 ticks, then my stop will then go to 0 + 2, and I'm in a no loss situation, right? Now what was my stop on that? 20 ticks. No, not a lot of ticks. Let's say that I got filled right now, just as an example. Then, all right, then my jump stop will kick in right there at that low. Whoops, wrong tool, delete. Here So my jump stop is going to come here. If price comes down here, right, and hits that, if I were to be filled right now, it would come down, hit that, and then drop my entry down to take my stop down from $820 to break even plus 2 ticks. So I couldn't get hurt on that. I like jump stops, right? And then after that, it's going to trail $500 behind. So let's change this back over here to dollars just to show you how that would work. Oops, I don't want to edit order. I want to change this one. Preferences. Let's go over here to dollars. So if my stop did come down here, we're trailing $500 behind the market. And when that does, then the stop will come back, will drop again, and it'll keep dropping every $500. And that's the way that jump stops work. Let's go back in here and look at a Swiss. All right, here's the Swiss franc. I put an order on the Swiss franc this morning based on, guess what? Based on seasonal tendencies. As you can see here, that market from May the 7th through the 29th is supposed to be bearish. And look what happened on the 7th, it dropped. So I came back in this morning and I put a sell order just below that support down in here. I didn't want to put it too close to that support because, as you know, sometimes the markets will come down. I think Land calls them a nasty boy, where they'll come down and just go through that and bounce right back up. I refer to it as a camel that stuck its 10 under the nose and didn't like what it saw and turned around and left. Right, and that happens sometimes. So I want my stop a little bit further down than just right underneath it. Right, then I've got a jump stop here. I already measured that out. I haven't put it on this chart. Let me do that. A 24 and 2. So if that market moves 24 ticks in my favor, my stop will then go to break even plus 2. And then I'm going to trail, let's trail 500 behind again. We can always adjust this later. All right. And my initial stop is up here. Right? Just above this resistance. I'm taking a $787 risk at maximum, but if it goes 24 ticks in my favor, I go to break even. All right, I'll keep that in mind. Let's look at gold. Here's gold. Kind of scared of gold today because of the Iran deal yesterday. No telling what might happen. But as you can see, gold is rated bearish, 5.0. Probabilities are high, 7 years of history and 6 wins. 19 bars, 24 actual days, so about 3 weeks. Right now, I don't know whether I want to short gold yet, because like I said, I'm kind of concerned about what happens on this Iran deal that was Trump talked about yesterday, pulled out of the Iran deal, right? Which could affect gold prices. But it's got support down in here. Now, if I wanted to trade that, I would get short down below support down in here. All right, let's look at copper. And in fact, I was looking at copper this morning during the webinars. All right, it's got a wedge here, as you can see. Bearish from the 11th through June the 13th, rated 4.2. No probabilities yet on copper, I don't think. Let's see if it did a copper. It did. It just changed today to a medium. I recalculated. So let me go back here and change that. Preferences over here to probability medium. I look at medium being maybe a 50-50 chance. All right. But the market certainly does look bearish to me. Right. So if I was going to do something, I'd wait for it to break support down in here. I'd do a trailing stop either up in here or trail blue light or go to another time frame. I might go down and look at a 60, see what risk looks like trailing on a 60-minute chart. Right. Here's blue light. Now, if you wanted to, You could do an intercept order right now on blue light, but I'd rather wait. I'd rather wait for it to break this support down in here because that's double bottoms, double support. All right. Silver, kind of concerned about silver this morning. What might happen to silver? As you can see, early this morning, that market took off on the open, came back down some, but it did take off on the open. There's a little 3-day pattern here I'll call a blip, which we'll get into on another session, but they're excellent little patterns. I love them. All right. So here, that's supposed to be bearish. Now here's an example of one that's supposed to be bearish. Rated 3.85 from the 1st to the 25th, I'm sorry. 8 years and 7 wins. So here, that market came in and it was bearish that day. It broke through this support down in here. And we've had a little bit of a drawdown here. You'd had on a daily basis, if you'd had your stop that high, you'd have been a drawdown of about $2,200. But you can always get in. Now, just because the market, the seasonals tell you to be short that day, doesn't mean that you have to be. You want to wait on something to happen to tell you to get short. You want a pattern to be broken out of. You want support to be broken. You want a Fibonacci to look at, etc. Another reason to be short. You want to wait and get short, not just get short on the day it tells you to get short. That'd be kind of stupid, right? You want the market to be working in your favor. Here's Kansas City wheat. All right. The Kansas City wheat is supposed to be bearish, rated 3.97, high probabilities, 5 years and 4 wins. Now, I'm not trading wheat today because we have the WASDE crop reports that's coming out, which can be very, very nasty. So I'm not trading any of the grains today. All right. Here's Minneapolis. Same thing is supposed to be, whoops, it's supposed to be bullish. All right, rated 1.82, which I said was weak. No probabilities yet. 7 years of history and 6 wins. And you notice that my lines here, my vertical lines, are now green. Gives me a very quick visual that this market is supposed to be bullish. Now, if you wanted to, you could go in and put a little bulls and bears or some other icon on that chart just to let you know. All right, so I'm looking for a buy scenario coming up in here. I don't see it yet. All right, price is coming down, still in this narrowing wedge here. All right, but you can see over in here, price starts to rally. These are the historicals down in here. These lines down in here, I've got those set up. As you can see over here, historical averages, values 3 and 5. The blue is 3 years of historicals, and the white is 5 years of historicals. Right. Then I've also got the seasonals down here, and I've got those set for 3 and 4. So anyway, I've got 3 and 4 set down here, and I've got 3 and 5 set up there. Kind of gives you a visual representation of what those markets did during the past. All right, so I'm waiting on that one. I'm not doing anything. All right, Euro Swiss. Let's look at the Euro Swiss. All right, so Euro Swiss is supposed to be bullish, rated 5.0. Probabilities are high. 6 years history, 5 wins. That market has been going up. Then you probably can notice here, and I'm not nearly as good as Lynn on drawing out these wedge patterns. But as you can see, there's a wedge here. And it broke out of that wedge yesterday, all right? Probably happened last night, all right? Or late during the day or something. Anyway, it broke out and it's heading back up a little bit. I'm not going to buy that yet. There's $700 worth of risk on that. I don't know what caused that drop yesterday. I don't really care what caused it. All I care about is that it dropped, all right? I'm not trading that now. Let's look at beans. Again, I would not trade beans today because we got the WASDE. But look at this. Got a wedge pattern here. The market rallied, hit the high, came back down. Look at this, right there to that 62% level again, which I was talking about earlier, right? And I typically do not sell 62% or 50% levels. I will more often buy them than sell them. All right, now this is supposed to be bullish coming up from the end of the month, the 31st through June the 29th, which is the closing date over here. All right, you got 28 actual days, 21 bars, 3 weeks. All right, so I'm waiting on that. Now it does look good here for a buy actually. If this support holds, it's hit it 3 times, including today, but we got WASD today. WASD has big, big, big teeth. All right, so don't trade that. All right, here's wheat. It's supposed to be bearish. Weekly, a wheat rating of 1.87. Probabilities is high. 5 years of history and 4 wins. And it has turned. Now, if it weren't for WASD today, coming out this afternoon, I would probably do an intercept on that. But sometimes that report will come out and it'll be a huge swing one way and then right back up again. So I don't like trading on crop report dates. I don't think that it's a smart thing to do. So there's how I use my seasonal charts. Now, obviously, you want to have different patterns that you're looking for, support and resistance, Fibonacci retracements, other reasons to get into that market. Milan covers that in his crash course very, very well. I just wanted to show you how I use seasons. All right. Now, if you're using Track and Trade live futures, which most of you are, I will share this chart book with you. So you'll have all the seasonal trades already done. Just send an email to david@davidduty.com and say, hey, I want the chart books, the seasonal chart books, or chart book, I should say, for the month of May, and I'll be happy to email that to you. And then what you're going to do is take it from your email, save it to your desktop, and then go over to your file and open and find out wherever you save that file. All right, and then open it from within the application. You can't double click on it from the desktop, it won't open. All right, let's see what else I was going to show you. I've got an option course that I think would be beneficial for you if you'd like to take a look at it. And it's an electronic version. I've also had the printed course, and I put it into an electronic version. And the students like the electronic version better than they do the printed version. And I've got a link that I'll send you if you ask me for the options course. I'll send you over to that link, and you can enroll in the trial version of the options course. Get a little bit of an idea of how that works. I also do a live daily trading room starting at 8:30 in the morning Central Time, 9:30 Eastern Time, and they go for about an hour and a half, something like that. Yesterday was a little bit longer, a couple hours. Today was a little bit shorter, it's a little over an hour, but usually about an hour to an hour and a half. And those are recorded, so in case you missed the meeting or something, you can come in and watch the recording at your convenience. All right, let's see what else. My website, might as well put that in there. I don't think Lan will care. Is www.commonsense. It's commodities.com. And you can get a free course over there. You can also get a 2-week trial for the live daily trading room. And if you'd like to do just a bull session with me, sometimes for 30 minutes or so, go over to trademinners.com. And everybody knows where Trademinners is. That's how you got into Lan's crash course, probably. So anyway, go over to trademinners.com and click on my picture and schedule a bull session with me. It'd be for 30 minutes. And then I'll get back with you and let you know, if I'm available on that date or if we have to reschedule that or change times or something. But I'll do a free 30-minute session with you, answer any questions that you might have. Well, anyway, if you have any questions on the seasonals or what we talked about or what I talked about today during the webinar, just like I said, send me an email. If you want to take a look at the options course, send me an email, say, hey, I want to look at the options course. And hey, I want the seasonal chart book that you're showing here. And I'll be happy to send those to you, no cost. All right. I appreciate your time. And again, if you have any questions at all, just here, let me do this too. I'll even give you my phone number. Now, I'm in Panama. I've been down here for 11 years and just love it. But my phone number, U.S. phone number is 417-7230. 417-7230. And that will ring me right here at my desk in my office here in Panama. Give me a call. Drop me an email. I'm glad to help you in any way that I can. Take care. I hope you learned a little bit. Oh, one thing I forgot to show you. I wanted to show you. I showed it last night. I want to show you again here. Lan and I had a good friend, Scott Berry. And Scott Berry showed me something one day that I'll never forget. And let's get a cleaner chart here. Well, there are no cleaner charts. But did you know that option strike prices will quite often become support and resistance levels? Let me get a market that's not moving straight down. Let's take gold. All right. That option strike prices will often become support and resistance levels. All right. So let's go over here to options and just say buy a call and watch this. Look at that. All right. There's support there. There's support here. See it over here? There's support there. Watch this. There's support or resistance here. There's resistance there. There's resistance right there. Resistance right there. I bet there's support here. There's support here. See? Option strike price. Support. Option strike price. Support here. Resistance here. Now you may be wondering, well, what difference does that make? Makes a heck of a difference. Because if you're placing stops or entries, don't you want them on one side or the other of that option strike price? If you're using a stop above the market or something, when you want your stop price to be above an option strike price, or if you were long the market, when you want your stop to be behind or below a strike price, of course you would. All right, so keep that in mind. That's a really valuable little tip that I'm giving you here. It's not my tip. Scott Berry gave it to me, and I'm passing it along. All right, take care. Appreciate your time today. Take care. Bye.